say my edge is that I've got a comprehensive knowledge of the oil and gas industry. The fact that, I've been exposed to projects and investment decisions in more than 30 countries, globally. I understand the operational challenges there. I understand the fiscal regimes. I know how long it physically takes to move the needle in some of these regions. I definitely feel like that's my edge. It's just the comprehensive knowledge. So.
Excellent intro. I thought we could start off today with the Permian and looking at the oil price. Seems that it's more enough to have a profitable production there, but at the same time, we're speaking with insiders, and they're saying that the rig count hasn't really been picking up. At least that was the last update we got not too long ago. And any thoughts on where this is going?
So when you think about the Permian and you think about the efficiencies that we've seen over the past 4 or 5 years, especially, a lot of those drilling efficiencies have been drilling these more complex, longer lateral wells. And even like a lot of the mergers that have occurred in previous years, I mean, it was these companies trying to get complementary acreage nearby their existing leases so that they could drill these longer lateral wells. They needed more, fairway nearby to tap into. But not every rig can drill a 3-mile lateral. And so like when you look at the rig count, even though it looks like there's a dearth of drilling rigs available, there's not a dearth of high spec drilling rigs available. And so that kind of caps the activity. Now, in a high oil price environment, companies can kind of ask themselves, well, maybe I drill a less complicated well here. Like I know that that's going to be a more expensive well for the amount of oil that's produced. But it's also going to make their metrics look, not so great, because then all of a sudden it's going to look like their efficiency is diminishing as these lower spec wells kind of come online. And these companies are also having to ask themselves, what does my runway look like? Like if they already had only 8 years, versus of reserves left, they're thinking, well, should I work on escalating or bringing that production forward, or should I focus more on maybe more trying to grow through acquisitions? But in this price environment, you actually probably wouldn't want to be growing through acquisitions, because no one's going to sell themselves, at a cheap price. Like they're going to be trying to sell themselves at a premium. So there's always kind of that trade-off there. But I believe that you're starting to see, and we're starting to not just see, but realize more and more of the technical challenges in the Permian with actually growing production, because you also hear a lot about the acreage quality and the acreage degradation. So a lot of the tier 1 acreage has already been drilled up, and as you tap into the lower quality, the tier 2s and the tier 3s, they work at these high oil prices, but they're also bringing on production at a higher price point. They have more water with the oil. So it's like on average, you probably are already producing, 4 to 5 barrels of water for each barrel of oil in the Permian. Some of these lower tiers, might be, 6 or 8, barrels of water for each barrel of oil. And the water management in the Permian is already a huge, huge challenge. So the way that in the past that the government was allowing companies to dispose of their water has actually created catastrophic failures in a number of the old existing wellbores, because a lot of people might not realize this, but there's like 1 million wells in the Permian Basin, and over 500,000 of those wells might be more than 50 years old. I mean, these are really fragile wells. They've been plugged, but if they weren't plugged correctly, like maybe they were plugged during a low price environment, and it was just kind of like slapped, the plug was kind of slapped down there, or maybe the cement job wasn't perfect. Like if there was any pockets where the casing was getting exposed to, you know, corrosive water, eventually a hole forms and that well is leaking. And more Texas is having leaking well problems. And it's not just Texas, it's other states as well. But the problem with Texas is for the last, you know, 5 or more years, they've been allowing these shale companies to dispose of their water in shallow zones. And those shallow zones are breaking through to these old well bores, and they're leaking. And there was even recently a lawsuit that occurred between a rancher and Chevron, because this ranch, you know, had hundreds of old Chevron wells on it. They'd all been plugged and it was no longer producing. But some of these wells started leaking, and the rancher had enough money that they excavated like 100 wells on their property. And they found that all these wells, every time they excavated a well, it was leaking. And then they got, you know, other people involved with proving up their case that there was cross flow occurring between injector wells nearby and you know, their wells that were leaking on the property. And for years, Chevron was like fighting this, because let's face it, a big company can fight a single person and then usually get them to like walk away just because they can't afford the fees. But I mean, this rancher stood firm. They were spending the money for the legal advice and all that, and it basically got right up to going to court, and then Chevron settled out of court. So Chevron ended up giving them a cash payment, buying their property out, you know, from underneath them. I mean, a lot of this stuff is it's not publicly available. Like, you just know that a settlement was made, and you can rest assured that it was a pretty large settlement that was made that made this rancher, you know, quite happy after a multi-year fight, you know, with a big company. And that's only going to open up more and more potential for other people in that region to start doing that as well. And more, a lot of the big oil companies are actually starting to buy the surface land as well, because, you know, they want to more or less control their own fate. Like if something starts leaking, you know, on their property, you know, they can repair that leak quietly. But, you know, when it happens on some rancher's land, and then now every, you know, news media company is called about it, and you know, the major news networks are interviewing these people online. I mean, it's a very bad look. So, but I mean, I guess long story short, where and how they're going to manage the water disposal point forward in the Permian Basin is a big issue, and it's a huge theme for me, because they're already making 25 million barrels of water per day. That number, like, it's hard to fathom. I mean, it's, you know, and in conventional reservoirs, this is probably something I need to explain. In conventional reservoirs, the water isn't as big as a challenge, because as the pressure depletes from the reservoir, you can simply pump that water from your oil and gas well onto the edge of the conventional reservoir, and you can use that pressure drive to like push more oil toward your producing wells, which is actually a good thing. You know, that's like your pressure balancing system. But that's not how shale wells work. In shale wells, they're making fractures, you know, with the fracking. That's why fracking is so important. But that media there, the shale, for the most part, isn't porous. So there's no way for them to re-inject the water that was extracted from the shale back into the shale. At least right now, there's not. And so they have to inject that water into conventional zones that are maybe depleted from 100 years of oil production in the Permian. But the volumes just don't work, because the volume that's being produced from the shale is so much higher than the volume that was ever extracted from the conventional reservoir. So now we have a pressure problem. right? Now that's what's causing all the overpressurization. I mean, you can look at the Permian Basin like on satellite maps, and you can see that the Permian Basin, for the most part, has either sunk down because of the massive amount of oil and water and gas extraction, or it's bubbled up in areas because they're pumping too much in, you know. And then there's a further complication that when these areas kind of shift down, like it might lift up in another area. So, I mean, like these are extreme issues that the industry has never really had to face before. And especially not at the scale of the Permian Basin, because the Permian Basin is such a large region and there's so much oil and gas coming out of it. And let's face it, like the globe is dependent on that production from the Permian Basin. Like that's what's given us cheap oil for 15 years. It was the scaling of the Permian Basin so fast and so hard, but it's not sustainable. You know, it's not sustainable in the long term. And you know, there's just always these knock-on effects. And so, you know, like I said, I kind of always keep a side eye on what's happening with the water in the Permian, because at some point in time, I feel like it's going to be water handling bottlenecks that force the Permian Basin to slow down. Not so much the oil price, but they physically can't manage the water. And like the Permian is basically, you know, two zones, right? The Delaware and the Midland Basin, like two sub-basins within the Permian Basin. And, you know, there are some experts that are saying that the Delaware side is going to run out of water disposal capacity within just a few years. And I'm like, okay, well, that's a pretty big, you know, black swan event. And so far, it's not being reflected, right? It's not being reflected in EIA forecasts or anything like that. So because you know, a lot of these groups, I mean, everyone just assumes that you're going to find a way to manage that challenge. But historically speaking, like even in conventional reservoirs, a lot of oil always gets left behind because it simply becomes too expensive to produce that oil. And eventually the same thing will happen for shale. It'll just become too expensive to extract that residual oil.
Excellent. Let's backtrack a little bit there. You mentioned the high spec rigs. So basically, it sounds like that's where the future is here. And what does that imply? Will we see a lot of orders going in for new high spec rigs, given that seemingly a lot of this rig fleet is outdated for the needs currently on the Permian?
Well, like in the Middle East, you already saw groups that were building out new rigs. You know, that Saudi Arabia already had rig orders going on with neighbors, and so I do think you'll continue to see, you know, high spec rigs being added, but we're probably going to see higher rig rates first. So, and I don't know if you just want to skip ahead now and talk about rigs. I'll wait till because eventually that's going to lead into a point that you kind of gave me a teaser on your this is what I'm going to ask you. So I'll wait for you to ask me questions.
Interesting topic of the race there. I mean, how much do they have to go up before we start seeing companies rushing for new builds?
Well, that kind of goes back to the macro, right? How long is this Hormuz disruption going to occur? How low are our inventories going to get? What happens with the escalation of the war in the Gulf Coast countries before it's all over? Because I mean, we already see that there might be some supply disruption, you know, in outer years, even if the war is resolved today. But if the war escalates again, the first thing that Iran is going to do is go hit, oil infrastructure in all those neighboring countries. And if they do that, now, you've got an even more intense, higher for longer oil price environment in the years ahead. And they'll end up being a little bit more of a scramble for rigs in other regions to try to fill that gap, in the near term. So I literally just had this conversation yesterday. Like, someone had contacted me because they were trying to sell me some micro data for the US. And I was just like, you know what? I'm not super keen to spend a whole lot of time looking at small operators buying leases nearby and things like that. I'm like the most important thing for the oil and gas landscape right now is what happens with the Strait of Hormuz. Like, how does this war get wrapped up? I'm like that situation. It's the most important factor, So needless to say, he didn't sell me anything, but I'm like, I don't need paywall data. I tend to be able to get everything I need from monthly reports that are like, I know how to look at leading indicators from statewide data on permitting and things like that. So yeah.
So we discussed the rigs here a bit. We've touched a bit upon the producers. If we take a step back here and look at the shale as a whole, the whole industry, where in the value chain would you look for value right now? Would you look on the producer side, service providers, distribution, or other parts?
So, like, when I think about the value chain, I think about so for producers, I'm thinking about where is production scaling? Where has the investment already been made? So or also in terms of M&A. So for producers, look at which companies did, a major acquisition in recent years. Or look at companies that were maybe underinvested in the last couple, like recently, because they had a high capex spend, and maybe in that high capex was because they were, developing fields and building out fields where their production now is going to start scaling. And for me, those companies have been offshore companies. I tend to lean toward liking, offshore conventional assets more than liking shale because of the things that I just mentioned to you with the water takeaway and different challenges there that I just don't know when they're going to come up and bite. And they just make me uncomfortable. Like, the legality makes me uncomfortable. Even with companies that are doing, water cleaning, like, obviously their services are scaling. But I'm like, man, just the legality of what's occurring there. Like, I know that it's just a matter of time before these companies are sued, and I just don't want to be involved with that. I want to be involved in things where maybe I can just sleep a little bit better at night, without thinking that there's some big fundamental issue that just doesn't sit right in my gut. Also, and it's kind of the same theme when you look at oilfield services, because in recent years, you've seen a lot of companies performing, big acquisitions. And a lot of times those companies were doing an acquisition or a merger in order to diversify into other markets. So, you saw that, for instance, from H&P. They did a big acquisition that gave them more exposure in Africa. Neighbors has they've been working closely with the Middle East, and like I just mentioned how Saudi had them building out more rigs that will eventually go back to work. Obviously Saudi's had to shut in a little bit because of the war situation, and they don't have the egress through the Red Sea that that they needed to fully offset what's happened with the flow disruption in Hormuz. So I mean, they're like having to like curtail the production a little bit. So I mean, probably idling some rigs there. But yeah, there's like when you look at the service providers, you can see this theme over the last few years of a number of them getting bigger but also leaner with the economies of scale and how they're moving out into the basins. And the Permian, for all of its current challenges, I mean, clearly it's worked. It's made, it's delivered a lot of oil to the global environment. And a lot of companies, have been very successful and made a lot of money there. And that business model will continue to be pushed out in other regions. I mean, you've already seen it in Argentina. I think you're going to see it more and more in Mexico. You'll see it in the Middle East. It's occurring for gas in Australia. So if you do really like the unconventional producers, look at who's starting to dabble in international plays and like what their runway and ability to scale there would be. Because, as one region declines, other regions rise. Like that's just how it always is. And so they will use those same learnings and those same technologies to scale smaller basins in other countries. And there will be a lot of very successful players that come out of that. And I mean, anyone who follows YFP, right? They know, like that's what their thesis was. It was seeing that scale, and I mean that company has done great over the last few years. So
excellent. So the US has been quite in the spotlight lately, given its abundance of energy. And one of the topics we keep hearing about is the mismatch between the sweet crude produced and the refinery preference for heavy sour. And can you give us some perspective on that? I mean, what are the principal opportunities and risks arising from that situation? And maybe you can exemplify a bit by relating it to specific companies.
Well, so basically 70% of the refining capacity in the US is built out for heavy sour crudes. And it is possible to run the light sweet crudes through those same systems. The problem is that the efficiency of those systems slow down because they can't handle all the light ends that come off of the light sweet crude. By ramping up the light through their old systems, they would be generating less product overall, which is a huge issue. I mean, some people say that they might, lose as much as 20% of their refining capability to make that switch from the light or from the heavy to the light. You have seen over the last few years some refiners do upgrades in order to process more of the light. I mean, Chevron, I think they did an upgrade, 3 or 4 years ago, here in the US. But when you look at the economics, like how much that upgrade cost, I mean, they're very, very expensive, and they normally take, 5 to 8 years to pay back just the expense of doing that upgrade. So it's not a simple thing. So a lot of times the light crude that we do use is just being blended, it's being blended into the heavy to cut it down a little bit. And that's also really important a lot of times for the Venezuelan heavy crudes is it's being cut with the light and blended down. But the efficiency situation is the problem, because I think, globally, the refining system, like with the Strait of Hormuz, issue, I mean, we've lost 3 to 4 million barrels per day of refining capability. And so what's occurring now is that you're seeing the countries that can, like especially the US refiners, I mean, they are running the refineries, maybe before they were running at 90% or, utilization, now they're pushing it up to 95% utilization or all that. I mean, nothing's ever going to run at 100%, right? But we're also seeing a major explosion or a fire occurring at a US refinery like almost every week, because these facilities, they tend to have like heavy maintenance seasons like during shoulder season. But with the Hormuz situation, like they weren't able to have as much downtime as they normally would have had. And you're running them so hard that, like I said, it's not a matter of will a refinery catch fire this week. It's which one and where at, because, it's happening in Texas. It's happening in Louisiana. I mean, yesterday I saw one in Tulsa, Oklahoma. I mean, it's just like systematically one at a time, they're having an issue. And then obviously when there is a fire or something like that occur, that also, bites into the refining, efficiency, the capacity that they can run at in the weeks ahead. And like in Asia, you've also seen that some of these refineries they haven't even physically been able to get a hold of the crudes because of the massive amount of supply disruption. And so they've had to curtail, their production a little bit. I mean, it's a very tentative situation, and the market just seems to keep believing that the war is going to be resolved any given moment and we're going to go right back to how things were. But I think the reality is this situation is going to drag on, even if the worst case scenario is we return to an escalation in fighting and more infrastructure in the Middle East gets damaged to the point that it takes years for that infrastructure to be repaired. That's worst case scenario. Best case scenario is we have a peace agreement overnight, and then it takes months to restart the flow of those fuels. And for some of the infrastructure that's already been hit, it could take a year for them to get the parts to repair some of their refineries that have been hit and things like that. So I think it was Shale, they came out and said that they thought that 2 million barrels per day of production has probably been lost, for more than a year, even if things were restarted today. So again, you're looking at global tightness point forward. And so that makes you like when you think about the forward investment thesis for oil and gas names, in the years ahead, because everyone's like, well, we've had this great run up, is it going to continue running up or not? Well, I mean, look at the crude futures, and I don't know what it is right now, but I'm guessing right now it's probably about $80 for WTI in December. But if the inventories continue to draw down, it's not going to be $80 by the time December rolls around. It could be 90, 95. Like there could be a new floor on oil that's $10 higher than it currently is. And if war were to escalate and another couple million barrels per day gets knocked off long term, I mean, the new floor for oil could be 100. I mean, you just don't know, right? You don't know until the situation is over. But even in the best case scenario, like even if this was resolved today, I have a hard time believing that oil's going back to $80 come December. I'd be more comfortable thinking it's going to be $90, even if everything's closed up today, because of the inventory that's been consumed. I mean, like strategic inventory has just been, it's already been significantly drawn down by, 800 to 900,000, actually million barrels, right? And, but it's not over. Even if the strait reopens, there's still going to be multiple months of supply constraint that while the system restarts itself, there's not going to be this dearth of oil just empty onto the market. And I think that the floor is higher than the futures curve is, shows. Like, I don't use futures to forecast what the price of oil is going to be. You use futures, like from where I'm standing, to try to get a feel of whether or not you think it's going higher or lower. You know, like which way is the curve trending? Is it starting to trend up, or is it trending down in terms of movements month over month, right? And like I said, I believe the floor for oil is higher now because of the inventory destruction. So
excellent. Let's stick a little bit with the topic here. We've seen that Canadian heavy producers have been mentioned as one of the potential winners here of the current situation. Would you agree to that statement?
I mean, yes and no. The thing about Canadian producers is they are kind of constrained by pipeline takeaway at this point. So there's already times when their production exceeds their takeaway capacity. And so they're reliant on expensive rail to get their oil to market. I mean, they really needed the, I forget the name of the pipeline that was just built, but I mean, they probably should have doubled the capacity of that pipeline. And there are talks about expansions occurring, like maybe next year, but you know, until that happens, they're kind of constrained from growth. So I do think their margins are great, and you know, obviously, you know, they're going to be making more free cash flow, like just from that alone. But whether or not they would be a disproportionate winner, I wouldn't go so far as to say that, you know. I mean, anyone who's able to sustain their production, just maintaining your production flat in a higher margin environment is a winner. The disproportionate winners are the ones that invested ahead of the crisis, not knowing that the crisis was going to occur, and then all of a sudden, like for instance, Petrobras, like they already had their queue of FPSOs ramping up. So you know, they were already in a situation of increased oil production, and now it's increased oil production in a higher price environment. And there's other, you know, companies like that as well. I mean, you know, Talos Energy in the Gulf of Mexico. I mean, they had done a major acquisition and was doing infrastructure-led exploration, and they were kind of getting hammered for the last few years because of their CapEx spend. But now it's like, okay, well, their CapEx spend is declining and their production is rising. So you know, you know, I told you I wasn't going to talk my book, but that is in my book. You know, Cosmos in you know, in Africa, that's been my biggest winner this year. Like, I actually sold a Permian producer that had just been a frustrating stock for me for a while, but I felt like their margins were good, but it just wasn't doing anything. And I like, before the Hormuz situation even occurred, like I had, you know, because I listened to a bunch of earnings calls. Like, even if I don't invest in the companies, I tend to listen, you know, to 40 or 50 earnings calls, you know, each quarter. And so certain companies, you know, even though I didn't own them, I was kind of following them. And so I kind of knew that Cosmos was kind of going to eventually turn around, right? And so I had, you know, flipped another company into Cosmos, and then Cosmos took off like a rocket. And you know, and so it's like I just sit back and I'm like, okay, that just made my year right there. Like, Cosmos made my year. So and I still own it. So because I don't think it's done yet. So, but again, another company that was getting hammered the last few years because of their CapEx spend, and you know, now it's like ideal timing. Like, these assets are coming online and the kinks are being worked out, and we're in a high oil price environment. Spins behind them. So when you can find little jewels like that, like that's you know, those tend to be the outperformers. But you know, but they're hard to find, right? Like, these things don't just jump out at you, you know. So I guess if you're running your screener and something lags, you know, you always have to ask yourself why. Like, why is this lagging? You know, why has it been bad? And if the story is kind of turning around or if it's behind them, then that ends up being, something that is a great play point forward. But it might be frustrating for a while. And I mean, I'll even say that according to Talos, like I've held Talos a long time through a lot of frustrations because I was like, I felt like the turnaround was coming, and I was seeing it before the markets were. So, it's been a good performer, but it's not been Cosmos. Let's just say that. Cosmos has been like my rock star. So
let's just do a quick follow-up on the refiners. I mean, you mentioned the outages and fires because of the lack of downtime and repairs. And has any of this made the refinery part of this business of the oil and gas space stand out to you?
The refiners have kind of been the clear winners in terms of, like, versus producers so far. The real question is how long can these crack spread, because the crack spreads are really high. So the refineries are making great margin respective to the oil price increases, but eventually these refineries are going to be competing with each other for oil. Like, that's why you've already seen some of the refineries in Southeast Asia. And I think there might have even been like some in Europe that kind of had to reduce their production. And so eventually, if this situation stays as it is, some of these refineries, they'll see their crack spread shrink a little bit. And so at that point in time, we might see producers start to outperform. So, there's just kind of like going to be ebbs and flows on like whose margin is driving. And initially it was like the refiners, we were seeing their margin drive, but eventually they'll start competing with each other to buy the heavy oil that's been lost. Right. And when that happens, you'll see them lag a little bit. But in terms of competing globally for heavy oil, the US does have an unfair advantage, and that unfair advantage is Canada. So Canada has to export the majority of its oil through the United States because their ports aren't deep enough to get really huge vessels through, and they don't have the pipeline egress built out to their small ports. The majority of their volume flows into the United States. And so the US refiners get first cracks at that. And that's why there's normally a large price differential, and we get loads of cheap heavy oil from Canada. And then just when you look at the incremental cost of shipping alone that other countries would have to pay to get that Canadian crude, like, the US refiners tend to win. So long as they can not blow up so publicly. Like I said, that's the other thing. It's like, they're making a lot of money, but they're always in the news for having a distillation tower on fire. I mean, it's just so, I mean, like I said, there's trade-offs. Like, there's no place to invest in this sector that doesn't have warts, like, on some scale, whether it be geopolitical risk or just age or egress. I mean, there's always something. So, but I mean, high oil prices solve a lot of problems. So
we've discussed some names here already, but and we've seen that a lot of oil-related names have had a decent run. And would you say it's too late to join the party? And where do you see the greatest mismatch between pricing and potential right now?
So that kind of goes back to where you see oil prices in December. Where do you see oil prices a year from now? I mean, if you believe the Trump narrative, the US government narrative that things are going to be resolved and that oil is going to go down again, you probably wouldn't want to own any of this. But if you believe that these disruptions are going to be longer lasting than what the market expects, even if they're resolved. You know, like if you believe my thesis that oil is probably still going to be $90 in December, you know, you'd still want to own the sector. I mean, I have no crystal ball, but you know, I'm still in the sector, right? I mean, I know at some point in time the sector might sell off, because when the strait finally does get resolved, you know, the sentiment will shift, but that might actually be a dip buying opportunity for a lot of people, because soon the market will realize, oh, wait, these flows didn't immediately return. It's been a month, it's been 2 months, it's been 3 months. You know, global production isn't 105 or 106 anymore. It's only 102, but we're still consuming 104. Yeah, you know, so just be prepared for volatility. But, you know, there, you know, we all know there will be, but
Excellent. We talked a bit about the Permian and the technologies there, and we also follow quite a bit the offshore side, and kind of taking note of the fact that costs have been coming down there, and seemingly changing a bit the picture. And so let's dwell a little bit on the technology side. What can we expect going forward in terms of new leaps, lowering production cost, and who's going to have the edge here?
So costs were coming down because you were using the best equipment, and you were, like I said, drilling these longer laterals, and those were the only things that worked right in this low price environment. Now that we're in a high price environment, and the longer that we're in this high price environment, what you'll start to see is the lower quality stuff come on, or you'll see people with existing production trying to stimulate that existing production with enhanced oil recovery. So before, in that low oil price environment, these companies weren't able to afford enhanced, you know, oil recovery. But now with higher prices, you know, you'll start seeing more and more CO2 flooding. There's surfactant, chemical and surfactant floods that they can do to try to increase the production. You know, even the thermal, like in the SAGD expansion methods that occur in, you know, in Canada, that's actually a subsector that I don't follow as closely. So, but I do want to start doing more and more research in that to try to find like some niche providers, because like that's what'll start coming on. Like the more people are comfortable with this higher price environment, the more you're going to see marginal acreage start to, you know, to be gone after. And even like the small changes that we have seen in rig count and things like that, I mean, those probably are some more, you know, small players looking to catch a quick win. It's not enough activity so far to see really a production change overall, but those are subsectors that could end up being big winners from the higher the oil price. You know, sectors that will grow for no other reason than the price is now high enough to afford them. And then also workovers. So like workover activity, workover rigs, you know, this high price will incentivize these wells to be worked over and performed on, like, you know, people paying for more gas compression, more pumps and things like that. Like you'll see increased activity in those areas, especially if we're entering into this higher for longer, you know, oil oil trading in an 80 to $100 barrel range, or especially if it's oil's trading, above 90, point forward. Like I said, I can't predict what Iran is going to do, so it's hard for me to predict an exact floor, right? But I just have this personal sense, that I could be completely wrong, that the fighting will have to ramp back up before it's resolved. And if the fighting ramps back up again, every day just be looking for what got hit, because potentially knocking off more oil production even after the crisis is resolved.
Looking a bit at Petrobras, we touched upon it already. How does such a company compare to the Western oil majors? And you mentioned the investment they did before this conflict broke loose, and do you see that giving this company more torque than other majors going forward?
So Petrobras has far and away the best, most prolific wells in the world. Like, a lot of their wells they produce more per day than other producers. And they did have already, like, this queue of FPSOs being built out and being added. Like, already, these things were already under development, already being rolled out. So we know that their production is going to increase, most likely in the years ahead. But they're probably always going to trade at a discount to the Western majors because of the government involvement. So, in recent years, we've seen the government replacing well-liked CEOs. Like, they replaced 2 CEOs that the markets liked in favor of their handpicked persons. We've already seen the government meddling in their portfolio management. So sometimes when Petrobras has wanted to sell off assets that didn't have as much margin as they wanted, they were forced to hold on to those assets. Like, the government wasn't letting them spin those off. And spinning off legacy assets is part of the industry. Like, it's part of the rhythm. It's like the big companies tend to develop the fields, and they basically produce the best juice first. But then, as it gets more and more expensive to produce these assets that are longer life, they tend to spin them off to more agile, lower cost operators that squeeze those intels out. And I mean, and that's a healthy way to operate. But like I said, the government of Brazil isn't necessarily having that. They're wanting, I guess, a lot of these older assets to be nameplate Petrobras assets. And like that's why it trades at a discount. And that's why it's probably always going to trade at a discount. I mean, I like Petrobras. I've owned it many times. I don't currently own it. I probably need to look at it again. Like, I don't own it because I don't like it. I own it because I was chasing gains somewhere else. So, like I said, I just, have the sector kind of breeze, and it's like you have runners at one quarter and runners at other times. So I do, my portfolio kind of breeze by where I think that momentum might shift. I'm definitely not always right, but yeah, I need to look at Petrobras again. But like I said, I had scaled into some smaller companies because those smaller companies, again, thinking about margin expansion. So if a company has if they were already known as a low cost operator, right? Like, in a higher price environment, yeah, they increase their free cash flow. But the companies that were higher priced operators, they have a higher percentage increase in their free cash flows. So that was why, for instance, Cosmos and maybe some of these other names were outperforming. They were left for dead previously because people didn't like their cost models. And then all of a sudden, with the higher prices, the cost models like blossomed, right? And so you're seeing that margin expansion occurring. And so like I said, it's me chasing gains somewhere else. I'm not currently out of it because I have a problem with it. I'm greedy. So placing money elsewhere. So
let's have a look at the offshore side here. And I mean, we've seen, we follow the shipping side quite a bit, and we've seen how shipping has been compensated in other basins from the Middle East disruptions. And I guess we're likely to see the same on the offshore drilling side.
Well, so long as the Strait of Hormuz is closed, shipping has had to move like longer transit routes to try to move oil from SPRs, and then like even the rerouting of the crude to the Red Sea from the Strait of Hormuz, like it's had to move longer routes. So it's a little bit easier to see like the near-term gains, I think, in the shipping industry than it is from the offshore drilling sector. So even before the Strait of Hormuz situation, the offshore drilling sector was already seeing like increased activity and increased investment for those long cycle assets, for exploration campaigns, things like that. I don't think that the Strait of Hormuz situation is going to disrupt any of that. It really just kind of firms up the thesis that companies need to have multiple fingers in multiple pots, right? So, I tend to like diversified companies because if something ever happens in a region, like, that they've still got revenue coming from elsewhere. The markets don't always like that because they think it's a more complicated company, but like longer term, it's a good strategy as a company when they're looking at multi-generational strategies versus, seasonal strategies, per se. Like the offshore sector, with that increased activity, that's not going to go away. I mean, you're just going to see these companies, continuing to pay down debt, continuing to get more and more profitable. I own some offshore drillers. I mean, probably I haven't looked at my exact gains, but I would guess that Transocean was probably my second best performer this year. And again, I owned it before the Strait of Hormuz, but then I think I bought more. I have to go back and look at those at those exact dates. But but again, it's just knowing that the cash flow isn't going away and that they're continuing to shore up their balance sheet. It just makes you more and more comfortable, right? That especially when you look at one of my core part of my oil and gas thesis is that the Permian can't keep growing leaps and bounds. It forces investment, more and more investment offshore. You look at the success in Guyana. I mean, that's good. They're going to try to replicate that, in Suriname. There's people, talking about exploration campaigns in Uruguay. I mean, when the Mediterranean, like there's a lot of gas going on there. I mean, even Kuwait, which Kuwait has been absolutely hammered by the Strait of Hormuz, but in the last couple of years, the Kuwaitis have had a ton of exploration success offshore. So after that situation with Hormuz is resolved, I mean, you're eventually going to see more and more offshore development, in Kuwait. like they will use offshore production to offset problems that they've had with legacy fields on shore. So like that's how closely I follow the space. I mean, because I love exploration. Like that's always the fun part of oil and gas. It doesn't equate so much to like near term revenue, but when you look at the runway, it's like, okay, where's the shifts occurring and things like that. So the runway for these offshore rigs, I mean, it's solid. Like it's, they're just going to keep making money, so.
Let's finish off today by some reflections on the big picture here. I mean, we've talked about the US, the fact that they've moved into a very powerful position here in terms of the energy market and the disruption coming from the Middle East, and this is giving a boost to the energy businesses and also other industries in the US from what we're seeing. But on the other side, we see these predictions of scarcity, rationing, the end of free markets, state interventions going after the oil companies, export bans, and what's sort of looking at all this, what are your thoughts?
I mean, this is probably the hardest thing to talk about because I like to think with a rational mind, and rationally, I never thought that the US was going to start a war with Iran and that the Strait of Hormuz was going to be closed. A lot of times when people talk about export bans from the US and whatnot, I think, well, how would that play out in real time? If we ban exports, we're also a huge importer. So, I mean, Canada could turn around and say, well, US, you just banned exports. So, maybe we're going to refuse to sell to you. Of course, the problem with that is Canada doesn't have anyone else they can sell to because their lines are all piped to the US. But like outside of the oil and gas realm, you think, well, okay, let's like look at the US's debt and stock market as a whole. Like there's a ton of foreign investment in there, and there's a ton of foreign holders of US debt. Like, are we going to just screw them even more than we've already screwed them? Because let's face it, we started this war that they're all paying higher prices from. Like they could potentially turn around and just start selling our debt, which would crash the market and whatnot. So where that balance of power would occur, I think it's somewhere having to deal with interest rates and bonds, because we kind of already saw that during the tariffs, right? Like we saw the tariff announcements, and then I think it was Japan started selling a bunch of US debt, and the market started doing wacky stuff. And I don't know. I guess you can say the US has maybe already been warned. But at the same time, like when you look at the interest rate creeping up like it is, like our interest rate, we already are the government's making less money than its debt right now with these higher interest rates. So, but which is also crazy because it's like I'm looking at the 10-year, the 10 years up. I'm looking at the price of oil, it's relatively flat today, and I'm looking at the S&P 500 and it's having an up day. And I'm like, those three things don't align. Like you can't have the interest rates high and the price of oil high and the S&P all high. Like something in there is going to be wrong. And placing your bets right now, like that's what makes a market. But I mean, fundamentally, we could physically see the inventories globally going down. I mean, I know that those inventories aren't going to be refilled for years. So I'm like, and I know that oil prices move with the inventory. Like the reason why oil price, was so cheap last year was because of this big, oversupply and tons of inventory on the market. So I'm like, well, like I said, every day this Hormuz situation goes on, you're extending the supply loss on the back end. It's going to take that much longer to refill these inventories on the back end.